It's been a poor week for stock markets. The stock market has fallen every day now for 9 days, and we're on day 10, and we're already quite sharply off this morning. So if we carry on in this fashion for the course of this day, we look at an event that's probably not taken place for at least 12 years. So these are quite rare events to see markets decline, not just by the magnitude that we've seen this week, but moreover the fact that it just keeps falling with no real fight back from the bulls, or indeed short covering. What has driven this? Well, if we take a look at the first chart here, this is the yield on German debt, and you've seen a bit of a spike up there in yields. It was in the real safe haven territory here. This is where a lot of money is heading at the moment into German, US, and indeed some of the UK borrowings, the gilts or the treasuries, as a safe haven material. But what we've seen here is that Germany just spiked up a little bit, and the reason for that was that we had an auction of new debt earlier this week, and it was uncovered, and that is a very exceptional event, certainly the first time that has been seen since the formation of the euro. And we may look back on this as a technicality. It may be that the yields there didn't attract investors, or there may be some other technical factor, but it's been enough to cause further panics throughout Europe. And if we were to look at Italian, Spanish and other bond markets, including the French, yields have already pushed up higher. And we're just hearing rumour, yet to be substantiated, that a plan for Italian bond auction today may be cancelled, and of course I think that's weighing on equity markets. So the problems in Europe, I'm afraid, are looking still quite grave regarding the technicalities of the financial markets. If we do actually just take a look, the other feature of this week, which has been commented quite widely, is the position of the UK, because we're still in that honeymoon period for our gilt yields. We can see there that yields really haven't popped up in the way that Germans have, and we've had this crossover now where it's perceived that on 10-year money it's slightly safer to lend to the UK than Germany. Probably quite a surprise given the data that's continuing to pour out of UK at the moment, which is indicating that we are still continuing to suffer weak trends in the UK economy. But it's the advantage of having a Bank of England sitting there at the centre compared to the ECB's capabilities that I think is continuing to attract money into this market. So what is happening to market? I just want to first of all look at, we can take a quick glance here at the FTSE 100, and we can see this sort of sharp sell-off that we're seeing. We are looking at that 5,000 region for the third time, I think, in the course of 3 months, and the speed of the decline has caught investors out. So the year-end Santa rally looks some way off at the moment. But I want to sort of stand back and look at just the performance of world markets over the course of the year to date. The column here to the right is the indicated performance from world markets over the course of the year to date, and there are some quite huge discrepancies, as can be seen. So if we take a look at the top, the Dow and the S&P, the two principal markets, including the Nasdaq as well, of the US, showing between 1 and 6% falls year to date. Now compare and contrast that to the performance that's seen throughout Europe. The Euro Stoxx 50 down 24%, the French market down 25%, the German market down 21%, and indeed if we look at the Italian market down 30%. So significant discrepancy between the markets, and it's really, I think, endorsing that theme of international diversification in equity portfolios, which we've been talking about for some time now, but that really is showing the magnitude of the difference between the two markets. Fair to say, though, that FTSE down 13% in that is the best performing of those European markets. It is actually slightly outperforming the Swiss market, and given what the Swiss market represents, I think that is a good showing. Reflects the fact that the FTSE 100 is probably 60-70% of its earnings generated from overseas investments, so it's not really a reflective index of that. But an interesting table to look at as we approach the year end. Now, in terms of just some final equities I want to refer to, Lloyds Bank is continuing to plummet to new lows, management issues, concern over the banking sector, all these things aren't particularly weighing. We have met with Lloyds management. One question that we were keen to find out is, were we to have another housing decline, house price falls in the UK, and there's been talk of a magnitude, maybe a further 20% decline, although that's at the moment at the more extreme end of forecast, but let's factor it in. Lloyds tell us that the capital base of their business could well be reduced to about 7%. Now that still is, we'd obviously like to see it higher, but I don't think would necessarily require any sort of bailout or new equity funding call at the moment. So I think the message from Lloyds was, yes, we've got problems with management, we need to resolve that issue, but in terms of the financing of the business at the moment and its exposure on balance sheet, they're still trying to send out a reasonably positive message there. And we'll just put up RBS. It is a sector trend that is taking place.